Thank you very much. I might try and bring it back onto less controversial grounds, just talking about private market investing. The proposition sorting the wheat from the chaff, which private market investments? Let me start with the answer to that, perhaps refreshingly, and then we can all go out and have a drink. We believe in private market investing as a value add in portfolios. What are private markets? Well, basically any assets that are non-traded on public markets. It's pretty simple. But in reality, what that means is we're talking about private equity, we're talking about private credit, and of course that's the asset class du jour at the present time. We're talking about direct infrastructure, an asset class that originated in Australia but has now gone global. And we're talking about, of course, direct real estate, particularly commercial real estate. And all of those have certain things in common. They are inherently illiquid. And so investing in them, you do need to be cognizant of that illiquidity. And in fact, that's the reason for investing in them, because what you're trying to gain is some premium in return for giving up liquidity, so an illiquidity premium. And it is observable over a very long period of time that each of these asset classes has actually delivered a yield return over and above what the public market equivalent has given. Over shorter periods of time, it becomes a little more perhaps tenuous, but certainly over that longer period of time. They are, I think, suitable for more sophisticated investors. Now, that's an important consideration because we are going through a period, and one of the most powerful forces, I think, in the market at the moment is democratization of investments. You hear that a lot at conferences. I think we are seeing that playing out across these asset classes. And inherently, that's a good thing, but there are some important caveats associated with that that I'll talk about as we proceed as well. Let me start with a bit of a skip over various asset classes here, really just to give you a flavour for what our views are, and then talk about some of the underlying considerations for investing in this space. Clicker. Yeah, big button. Hang on. We'll go back. Okay, let me start with private debt. And the reason for that, I guess, as I said, it is the asset class du jour. If I had $1 for every conference that private debt featured in at the moment, I wouldn't, frankly, be standing in front of you today. Why is it so popular? Number of theories for that. It is a relatively recent asset class. And we have seen it really take off post the GFC, when a lot of banks in the US, Europe actually got out of commercial lending, and the private debt market really took off at that point in time. Roughly approaching $2 trillion US at this stage, so it's certainly grown substantially over the course of the last few years. In Australia, it's even more recent than that, and I think a lot of the recent growth has probably got to do with the sunset that has been imposed by APRA on the hybrid market, the tier 1 hybrid market in Australia, which has been, of course, very popular with retail investors. We have seen growth in it in the institutional space, which has been very attractive, but more recently it's been targeted towards the retail market. It's approaching roughly around 200 billion in Australia at this point in time. One of the interesting things, observations from our point of view, it's delivered very strong returns for about a 15-year time frame, which basically takes us back to the GFC period. The returns have been, on average, high single-digit, low double-digit, so very attractive, and it has produced a margin above the comparable public market, credit markets. Capital losses have been quite muted. We have not really seen a default cycle in private debt at this point in time, and that's a really important consideration. On the one hand, that's good news. I mean, we don't want to see substantial default cycles, but on the other hand, we haven't really seen the asset class tested, and that is a consideration for the future. And obviously, a lot of people are concerned about whether we're seeing the harbinger of that in the US at this point in time. Default rates at the moment are quite low. And you compare that against public markets such as the syndicated loan market, the high yield market, and you can see on the right-hand side there, generally, private debt markets are showing quite low default rates. But there is some concern that maybe it is hiding a story that actual default levels are a little higher. And by the nature of this asset class, fund managers are able to actually restructure loans a lot easier to actually hide the true level of defaults. But assume maybe it's around about 4 to 5%. It's not earth-shattering. It's certainly not at levels that we're seeing during the GFC. We don't think there's a systematic crisis looming in private credit at this point in time. However, we have downgraded our view on private credit. We were very favourably disposed towards it. We've got a lot of our investors, institutional investors, invested in it at this point in time. Very attractive for them. It forms a very sensible component of a fixed income portfolio or perhaps a more liquid defensive alt portfolio. However, there is concern about the illiquidity that has come through. We have seen a lot more issuance occurring in this space. And in particular, there's been a focus on the level of issuance that we've seen associated with AI in the US. So people are getting nervous about perhaps more sectoral risk-related issues in the US. And as a consequence of that, we're starting to see, just spreads widen a little. People concerned about perhaps diversifying a little further. Now, to put it in context, and I think this is really important from an Australian lens, when people worry about this level of concentration risk associated with AI in the US, we're talking about, at this stage, maybe an 8 to 10% exposure to AI in the private debt market. It has come from about 1 to 2% only 1 to 2 years ago, so it is growing quite sharply. It is a potential problem for the future. You can see it continuing to accelerate in the current environment. But the reality is, in Australia, we have a private debt market that has something like a 50 to 70% exposure to real estate development and construction risk. So if we're talking concentration risk, worry about the Australian market more than the international market. And for this reason, one of the concerns that we have is the level of investment that many investors have in Australia in private credit that is so concentrated on just Australian fund managers. Our view is that if you're going to invest in this space, look at having a well-diversified pool of managers. Perhaps 3 managers would be optimal. One of those managers might be Australian, 2 should be international, and of those, maybe 1 in the US, 1 Europe. We're not seeing that in more wholesale and retail books at this point in time, and that does concern us. There's sort of this tangibility issue. I'd rather be invested something closer to home where I understand the underlying investments, notwithstanding the fact I also have exposure to those investments through my bank shares, perhaps my REITs. So you can see there that there's a thematic risk that infects most portfolios in Australia that we see that is reinforced by private debt exposure. That's what concerns us. Anyway, moving on to private equity, it's not all about private debt. Private equity, as one of the earlier speakers had mentioned, is an asset class that's probably gone through a bit of difficulty. There was a bidding up of values post the 2020s when we had the COVID lockdown. Low interest rates funded excessive valuations in this space. That's actually started to unwind. And in fact, over the course of the last couple of years, we've actually seen a significant improvement in valuations. And actually, if you have a look at the performance of private equity over the course of the last year or so, it's actually started to accelerate. Secondaries are doing quite well. Buyouts are doing quite well. We think this is an asset class. While we're not upgrading our exposure to it at this point in time, we think that the vintages that you can invest in at the present time are probably going to be some of the best that we've seen in the course of the last decade or so. So we're quite encouraged by the situation that we're seeing in private equity funding at this point. We believe it's a buyer's market. The opportunity in a more difficult economic environment, a lot of companies are looking to offload non-core businesses. So there's buyout opportunities, there's a lot of secondary activity. People have been very cautious about that because they've been concerned about perhaps related party transactions and are we really getting value from it? We actually don't see that same problem. We think that the secondary market is quite attractive at this point. And there's just a large opportunity set. There's a lot of potential investment opportunities milling around at the right time. We just need to see the right investors taking advantage of that. Property, direct property. A lot of conversation about real estate. In Australia, commercial property certainly has been the preserve of institutional investors for a very long period of time. We think the budget changes will probably make commercial property a more viable opportunity for investors in the wholesale and the retail market. The good news is that after a pretty lean period going through 23, 24, where rising cap rates as a function of rises in Reserve Bank interest rates, normalisation of the bond market, actually saw commercial property under a lot of stress. We've actually come out of that period now, and we're actually starting to see an improvement in returns. And really for the last 5 quarters now, we've actually seen positive performance in Australian property, particularly focused on retail and industrial. It's a little bit more mixed in terms of the commercial market. Sydney, Brisbane doing quite well. Melbourne really struggling at this point in time. So it's really a market story, or even a segmentation within the market story at this stage. So neutral overall, but we think that there are opportunities. And for the first time for a while, we're actually getting the positive returns coming through. It's not all about Australian property. Again, in this segment, if we're talking to an institutional client, it's a lay down misere that they're going to look at international investment in commercial property. We see it less in Australia. Again, this tangibility issue. We'd rather invest closer to home. We can see the commercial properties that we're talking about. In fact, some of the best opportunities that we see are in international markets. Our property research team came back from an overseas trip. They see the US market particularly interesting at this point in time, notwithstanding the interest rate increases that we have seen there. And the interesting thing about the US market, indeed the European market, is it's not just about retail, industrial and commercial, it's office. It's also got aspects hotel, it's got senior housing, residential housing. There's a lot more dimension to it, and of course AI is a big theme here, and that's one of the themes that our team actually picked up on. A lot of interest in AI investing in the property sector at this point in time. Really 2 principal themes that are driving that at this stage. Direct demand for data centres. They're basically looking at how you can directly invest in that, what are sensible investment opportunities there. And the other is how AI is affecting and improving the efficiency of managing property books across their entire portfolio. So they see that as a significant positive, but one that you do have to be very discreet in terms of who you're actually investing with. Infrastructure. Infrastructure, as I said at the outset, it is inherently or historically an Australian formed asset class, but it has actually gone global, and it is an asset class now that we are seeing a huge number of entrants really coming into this market from a fund management point of view, and indeed investors that are taking a much greater interest in this outside of Australia as well. One of the interesting themes here is that unlike some of the other asset classes, private equity, property, which have gone through a really difficult period and perhaps started to come out that over the last year or so, infrastructure has actually sailed through this period quite nicely. And if you think about it, during the period of normalisation of interest rates, where cap rates started to rise, infrastructure was negatively affected by that as well. But at the same time, one of the principal drivers of infrastructure revenues is inflation. So the very inflation that was driving cap rates higher was actually beneficial for revenue lines in the infrastructure space. And that provided a significant offset. So it actually acted as a very good inflation hedge. It attracted a lot of investors, and as a consequence of that, we've actually seen it growing as a proportion of portfolios. Again, one of the significant themes that our infrastructure team came back with from a recent overseas trip was the AI story. I mean, this is transcending property and infrastructure as a theme, if you like. And certainly we're seeing a lot of interest in infrastructure fund managers exposing themselves to AI. One cautionary note here is that they felt that this is beginning to turn into a bit of a gold rush moment, where so many fund managers are moving into infrastructure, a bit like what we've seen in private debt, but are specifically focusing on this AI story. And they feel as a consequence of that, that while the underlying theme is sound and will pay reasonable dividends, in reality, there's going to be a wide dispersion in terms of who's actually going to be investing correctly and who's actually going to perhaps blow their capital in this sort of situation. So from that point of view, their view is it's really a fund management and stock selection decision. It's not buying the theme itself in its entirety. So a summary: unlisted property neutral, unlisted infrastructure we're still quite positive about, with manager selection being absolutely critical for the reasons I've talked about. Private equity, quite neutral at this point in time, but there's some opportunities, small mid-cap buyouts, particularly quite interesting. Larger buyouts, which are very heavily debt funded, still a bit of a struggle at this point in time. Private debt, downgraded from moderately attractive to neutral. There is the opportunity in software, IT exposure, but that is probably where people have been most concerned, and we have to look at concentration risk. Something like 1 in 5 fund managers in the private debt space in the US now have significant exposure to this theme. So they're either going to do very well out, or they're going to be in some trouble. So considerations before investing in private markets. Manager selection is absolutely critical. People talked about whether there is a premium, a liquidity premium for investing in private markets over public markets. Yes, there is, but it actually is more pronounced than that if you get the right managers, because the dispersion between good performing managers and poor performing managers in this space is actually the key determinant. If you look at public markets, 90-odd% of the returns are going to be driven by the beta, equity, fixed income beta. In this space, you reverse that logic. It's really the top tier of managers that are going to deliver you the majority of returns. The remainder of the managers are going to struggle to beat the benchmark, or they're just going to deliver benchmark returns. So it's all about manager selection. What's the logic of that? Well, it's the managers in this space who can command the best deal access that are going to get the best returns from that. And those that have got the longest experience, have got the best connections in this space, the best deal flow, are going to deliver you the best returns. We also see a tendency for those managers not just to have delivered quite well, but past performance is actually a good guide to future performance. And that is a little bit different to what we see in public markets as well, where there is a tendency for mean reversion of manager alpha. So manager selection, absolutely critical in this space. Diversification, absolutely essential as well. So in this regard, what we would suggest, and the example I gave you of private debt, don't invest in just Australian debt managers. Don't just invest in one private market. Looking at a private market program that encompasses private debt, private equity, infrastructure, commercial property, if you can, and within that, look to get manager diversity. Now that can be challenging for wholesale and retail investors, which may suggest that pooled structures that can actually do that for you may be a better way to go than simply focusing on individual manager constructs. Managed account structures can do this, particularly MDAs, but there is a challenge here with the liquidity associated with these investments and how to manage that within a managed account structure. Importantly, it's not all about private credit. Private credit is very thematic. It's of interest to a lot of investors at this point in time, but it shouldn't be the only private market investment that you have within a portfolio. Absolutely critical, and I started with this point, private market assets are illiquid. There are all sorts of attempts to try and synthesize liquidity in this space. We have seen evergreen structures introduced, often with liquidity sleeves in them to try and assist with managing liquidity windows. We've seen the listing of structures in this space, all of them perhaps with good intent. But the problem with that is that you are still dealing with an inherently illiquid asset class. Our proposition is that democratization of investments in this space is fantastic, it's great. It's opening up an opportunity set for investors that hitherto have not been able to access this, that it might have been the preserve of institutional investors. But investors should not be investing in these asset classes unless they have the appetite for illiquidity. And the example of the US, where we've seen private debt funds gated, we actually think that's good news. We agree with one of the previous speakers. But the problem with that is that you've got this gating effect which is giving the asset class a bad name. It's not a function of problems with credit defaults rising. It's simply a case of perhaps the assets were either incorrectly sold, the investments were incorrectly sold to certain investors, or they nodded and understood, yes, it's illiquid, but then still wanted to get the illiquidity or get liquidity out of the fund. If that is the consideration, if that's the nature of the asset class that you're dealing with, then you are probably better off not recommending these investments. And I think this is a major concern for the regulator as well as us, that really it's horses for courses. These certainly serve a purpose in portfolios, but you have to understand the inherent nature of the beast. And we are going to see further gating in these types of investments moving forward. So don't put your clients' money in them if they do need to get out of it. So I'll leave it there at this point in time in the interest of perhaps some questions.
Thanks, Michael. We still have, about 5 minutes for questions, so we've got time for a couple if anyone has any.
I just wanted to extend the point you started to talk about, which is, do retail investors have access to these vehicles? So JANA, sees everything that's on offer to institutional investors and sort of intermediate investors and then down to retail and wealth. Do you think that retail and wholesale investors actually have access to the managers at the top end of the dispersion?
I think increasingly so. I mean, I think what we have seen is an understanding that, particularly in Australia, there is a rising interest in the wholesale segment. So we get a lot of fund managers coming to Australia that might have just had institutional interest in Australia in the past. And they're looking at, we're considering an evergreen structure to launch into Australia and asking our thoughts as to how it should be structured and so on and so forth. So I think there is that rising interest in addressing the market in Australia. The problem is, of course, when you start to get into the mechanics of understanding the investment, you've also got to understand the structure which is wrapped around it, and those evergreen structures do have various gating clauses associated with them that investors have got to be aware of.
Other questions? Do you want to talk a little more? You brushed over secondaries, and that sort of that part of the market. Do you want to talk a little more about that area?
Oh, look, I think, it's an interesting one. I mean, public markets have, by the nature, it's a secondary market. And private markets in the past, historically, have been about primary investment. You lock it up, you get your money out at the end, and that is the nature of it. What we have seen, and this really started in private equity for some time, has been the development of a secondary market. Now, it's not analogous to the public market. You can't go out and sell something instantaneously. The deals take a long time to take place. But we have seen the rise of secondary, and it's occurring in infrastructure now as well, and it's occurring in private credit at this point in time as well. And I think that is a good thing. That does raise the concern that some people have had is, well, if it's occurring between related parties, which quite often it is, if you're setting up a new private equity evergreen fund, for example, you may well look to bring in assets from one of your other primary funds. So that's fine. What are the terms, what are the valuation criteria that has been implemented in that? And I think one of the asset focuses has been on this conflict of interest management, where there are related party transactions occurring between funds that a fund manager might control. How is that actually being managed so it's in the best interests of all parties? Now, we look at that very closely when we analyse a secondary fund. We think that secondary funds have been a great place to invest. They've certainly delivered pretty good returns, but clearly ASIC has discovered, in their view, that there are some conflicts of interest that, particularly amongst Australian managers in the private debt space, need to be managed better. So I think that's an ongoing issue, and we certainly pay a lot of attention to that.